Hello and welcome to Hollenbeck Unleashed, a regular programme here on Dukascopy TV where we ask expert Dr. Frank Hollenbeck a number of questions on a variety of hot topical issues. Today Frank joins us once again. Frank, welcome back to the studio.
Good to be here.
Today we're looking at the US Central Bank, the Federal Reserve. Recently, the Federal Reserve announced that it would be keeping interest rates to near zero, providing that unemployment didn't fall below 6.5% and inflation 2.5%. This is expected to last, they say, till 2015. Is this realistic?
Well, what bothers me with what the Fed said is they didn't say anything about asset prices. So in other words, it's basically saying is that we weren't responsible for the housing bubble in the United States. And if we have another asset bubble, then we're not responsible either. And to a large degree, what the Fed did is they went back to a policy they've been following from 1983 to 2007. And this policy is known as a Taylor rule, where you adjust monetary policy, specifically the federal funds rate, to targets of either inflation, the unemployment rate, or growth. So the closer you get to the target, you either tighten or loosen monetary policy, or you raise or lower the federal funds rate. Now, the experience from 1983 to 2007 is that the federal funds, the Taylor rule was adjusted depending on what was politically expedient at the time. For example, in 2003, they lowered the federal funds rate to 1% and said that they would keep it there for the foreseeable future. Now, Dr. Taylor, who actually created the Taylor rule, recently wrote a paper criticizing the Fed during this period, that they should have been raising the federal funds rate much faster than they otherwise did, and that they're somewhat responsible for the asset bubble that was created. Now, for me, there's three problems with this policy that the Fed is following. The first one is that we don't know what money is. Suppose that I gave you 8 different definitions of a bouillabaisse, and I put a bouillabaisse in front of you. Would you be able to determine what it was?
Maybe.
Maybe not. And the problem we have is that the financial system has created an enormous amount of near monies. So even today, we just have no idea what money is. The second problem is that, like I said before in a previous interview, is that we're looking at the wrong prices. We shouldn't be looking at the CPI. We should be looking at all prices, including asset prices. For example, the BIS, in its recent quarterly report, indicated that we may be creating credit bubbles right now. In other words, they indicated that some asset prices are not really doing what they should be doing, in the sense that they're not consistent with what's happening in the economy. For example, high yield bond rates are relatively low, and they should actually be increasing because of the higher risk of default. We've had a reduction in estimated earnings into the future, but we still see stock markets going up. So they're basically warning, be careful, you may be creating additional asset bubbles in different areas. Now, you have to remember that it was the BIS that basically predicted the housing crash of 2008. And William White, who was the chief economist at the time, warned the Fed that it should possibly be raising interest rates, and it shouldn't be focused that much on the CPI, because he was seeing problems in the excess amount of credit creation that was going on during the 2001-2007 period. And the third thing is that the unemployment rate is usually a lagging indicator, in the sense that as the economy improves, people who are out of the job market tend to enter the job market, so that the unemployment rate could actually increase as the economy improves. So it's very probable that if the Fed follows an unemployment rate target, it will be behind the curve, just like it was between 2001 and 2007. So here's the question. You've just had a major car crash. Would you get into a car with a driver who's handicapped and whose policy is to look in the rearview mirror, okay, because there's a lag in monetary policy?
It's unlikely.
Well, I feel the same.
Ben Bernanke recently confirmed that the Fed would be continuing to buy government bonds and mortgage-backed securities, amassing to, I think it was $85 billion a month, which is what they've been doing anyway. Do you think continuing to do this is the right way forward?
Well, as I've said before, the central bank is a legal counterfeiter, and every dollar that it prints is a tax on your cash balance. So here we have an entity that's a non-elected body, okay, which is taxing the general population and then turning around and subsidizing one sector of the population, which is the housing sector. If I was Congress, I'd be very concerned about the tax and spending policies of an unelected entity, okay? And as we can see from this graph, the central bank intervention is going to reach $7 trillion by 2016. This is unprecedented when we look at history. And all we know from history is that such monetary easing can only usually lead to hyperinflation down the road.
Frank, thanks very much for coming in the studio. Some very interesting points you made there. Thank you. Well, that's it from Hollenbeck Unleashed for the moment. Stay with us though. We'll continue to bring you exclusive interviews and updates throughout the day. But until next time, goodbye.